Last time we opened up your fund and found one big thing: it's all shares, tiny pieces of thousands of companies. Shares are the engine of long-term growth, but they're also the bumpiest ride. So should everything you own be shares? Not necessarily, because shares aren't the only thing you can hold. There are 3 other building blocks worth knowing: bonds, property, and cash that earns. And the real skill isn't picking one, it's deciding how much of each. Let's take them one at a time. First, bonds. With a share, you own part of a company. With a bond, you're the lender instead. You lend money for a set period, collect interest along the way, and get your money back at the end. So who are you lending to? 2 answers. Lend to a government. In the UK that's called a gilt, and you're lending to the UK government itself, about as safe as lending gets. Or lend to a company, a corporate bond, which pays a little more, because there's a little more risk it can't pay you back. Either way, bonds are the steadier cousin of shares. They rarely soar, but they rarely crash as hard. And when shares have a bad year, bonds often hold their ground. That's exactly why people hold them. They're the cushion. Next, property, without buying a flat. No deposit, no mortgage, no tenant. There's a kind of company called a REIT, a real estate investment trust, that owns income-producing buildings, warehouses, offices, shops, rented homes. It collects the rent and passes most of it on to shareholders as income. Buy a fund holding lots of rights, and you own a sliver of all that property, and a slice of the rent, straight from your phone. It trades like a share, so it can be bumpy, but it's tied to bricks and mortar rather than software, so it adds something different to the mix. Then, at the calm end, money market funds. Think of these as cash that earns its keep. The fund lends to rock-solid borrowers for very short periods, and earns roughly the central bank's base rate. The trade-off is simple: the lowest risk of everything here, and in return, the lowest growth. It won't build wealth over decades the way shares can. But for money you want kept stable and close to hand, it quietly beats cash sitting idle. Now picture a ladder. At the bottom, the steady rungs, cash and money market funds. A step up, bonds, with gilts the safest. Higher still, property through REITs. And at the top, shares, the bumpiest rung, but historically the biggest long-run reward. As you climb, the potential return rises, and so do their ups and downs. Here's the key idea: you don't pick one rung, you spread across several. The real question is how much weight on each. 3 things guide that. First, your time horizon. Money you won't touch for decades can sit mostly in shares. Money you need soon belongs lower down. Second, your risk appetite. How calmly could you watch your pot drop a third in a bad year, and not sell? And third, how close you are to your goal. Many people start share heavy when young, then gradually add steadier holdings as the finish line approaches. There's no single right mix. A 25-year-old and a 60-year-old might own the same building blocks in completely different proportions. So that's the rest of the menu. Shares, the growth engine. Bonds and gilts, the cushion. REITs, property and rent. Money market funds, cash that earns. That's the whole menu, and one real decision: how much of each, based on your time, your nerve, and how close you are to the finish line. You've now seen what to hold, and how to balance it. Which leaves the biggest question of all, the one this whole channel has been building towards. Do all of this, stay the course for years, and what does it actually get you? Next time, we follow the money, what staying invested really adds up to over the decades, and how you turn that pot into something you can live on. See you there.